I'm speaking with Dion Hershan, Head of Equities at Yarra Capital Management. First of all, Dion, thank you very much for participating in the Inside Network's Equities and Growth Symposium 2025.
Good to be with you today, James.
Very good to have you here, Dion. And as we speak, of course, markets very, very turbulent. I would have asked you anyway, how is Yarra Capital positioning its portfolios in the current climate? But given that we've seen a very quick drawdown in the markets, how is the firm reacting to events as they happen?
Yeah, look, in the same way we'd address a bull market, we address a bear market in some respects. We are on the cusp of a bear market, which is to take a long-term, measured, thoughtful, research-led approach. And our view is, out of chaos, and what we're seeing at the moment is chaos, it is panic, phenomenal opportunities arise. But you need to be, in some respects, you need to be measured as to how fast you move, what you do. But opportunities, if you look back with the benefit of hindsight, these are windows of opportunity.
The headwinds for domestic stocks are concerning. They were already concerning. Are there any reforms you can think of that would help Australia, the nation, and the share market reignite some economic growth?
Yeah, I agree with your proposition, which is the Australian economy has been difficult. In fact, the Australian economy has been a grind for about the last 3 years since we came out of lockdown. GDP growth has been modest on a per capita basis, it's been negative, and the consumer's doing it tough. So we are in a very low growth environment. I guess what you asked was, are there any sort of structural reforms you could recommend? There's a long list of things you could recommend, but you also have to be pragmatic, and in my opinion, virtually none of them will happen in the near term. Structural reforms always require tough decisions. It requires conviction, it requires support and advocacy, and they invariably create losers. Long term, everyone might be a winner, but in the short term, they'll create losers. But the Achilles heel of the Australian economy is productivity. It's our inability to build things on time, on budget, and effectively. And I don't see that changing anytime soon because neither political party's got a strong appetite for industrial relations reform.
It was a very compelling presentation you made, and you've got a compelling strategy that you talked about the ASX top 20. A lot of it is moribund or even ex-growth, with its large preponderance of the banks and iron ore miners. But Yarra's looking at excising the top 20 from the ASX 200 and really looking at the ASX 180. Yeah. And then, it's quite amazing, then you have a different share market. You have different weightings, different economic drivers, different potential exposures.
Yeah, I think that's correct. So we run different portfolios for different clients. Some of them we run across the ASX 200, some, as you described, are X20. If you strip out the 20 companies, which is the heart of the question, what you do find is the portfolio is a lot more diversified because you're not reliant on banks and major mining companies. The projected earnings growth rate over the next 3 years goes from about 0 for the 20 biggest companies to close to 10%. And you find a lot of companies there that have got stronger growth, greater control over their own destiny, and they're not subject to the macro and geopolitical gyrations which we're seeing on an hourly basis.
How are cost of living pressures shaping your outlook on consumer stocks in the Australian market?
Oh, very specifically. I mean, you can't ignore the size of the consumer in the Australian economy. 52% of GDP is consumption. The Australian consumer is suffering from, it is a genuine cost of living crisis. Rates are still high. We've had 13 interest rate hikes and 1 interest rate cut at this point in time. Real wage growth is probably below real inflation when you actually look at the consumers. Confidence is well below normal levels. It's almost, I won't say it's recession levels, but it's well below normal levels. And what you're finding is the consumer, who's a lot more astute than most people give them credit for, is sort of preemptively starting to build up its savings rather than run down its savings. Recognising that the next few years could actually be tougher with inflation, with rising unemployment, and with possibly the government showing some restraint.
You mentioned productivity before. What's needed to drive a more sustainable level of private sector job growth in the Australian economy? Yeah,
so I guess the proposition you put forward is absolutely true. Private sector job creation has been almost non-existent for the last 2 years. 75% of the jobs created have actually been government-sponsored or government-owned jobs. What there is in corporate Australia is a crisis of confidence around investing in Australia. If you look at capital expenditure as a proportion of GDP, we're actually at a 20-year low. That's notwithstanding the fact that a lot of corporates are cashed up and it's relatively easy for them to borrow in this environment. There's an investment strike, and there's investment strike because it takes an eternity to permit things. It's a very bureaucratic process. Our labour might be high quality labour, but it's certainly amongst the most expensive labour in the world, and it's highly, highly inflexible, both to hire, to fire and to reshape. And by virtue of that, what you're seeing is a lot of companies are hoarding cash. They're undertaking buybacks and dividends, which in itself is not a problem, but what it does speak to is a lack of investment for growth.
Amid margin pressure and weak earnings growth, where are you finding the best equity opportunities, the best earnings prospects? Is it in that 20 to 200 level of the ASX 200?
I think what we're finding is it's typically outside of the 20 biggest companies, because outside the 20 companies got more control of their own destiny. They're a micro play rather than a macro play. But if I was to pull it apart and say where are some sectors where we do see real growth, in the resources sector I think you need to be very commodity specific. So we've got big investments in the gold space, energy and also base metals like copper. We do see real growth and a lot of potential there. In the tech sector, we found a half a dozen high quality businesses with pricing power that we think can prosper even if the economy is difficult. And then we find just some quality industrial companies where they've got a proven business model, they've got good productivity gains and they're growing. So it's hard to be categoric there, but we do see real opportunities.
Dion Hershan, Head of Equities at Yarra Capital, always a pleasure.
Great, thank you, James.